Hi, I'm going to go to the balance sheet assumptions on the Get Started sheet. Most of these assumptions are optional, but useful if they apply to your type of business. Cash on hand assumption here, it reflects to the amount of cash you have on your books, kind of going into the first month of the forecast. Useful if you're looking at understanding future cash needs, forecast out your revenues and expenses, and you currently have cash in the book, so make sure you account for that. The way this input gets used is it flows into the statements on the opening balance sheet on the statements. If you have a full other details for your business, you can obviously input the opening balance sheet there, but the most important one is cash, and so that's why it's on a Get Started sheet. The revenue recognition sheet inputs, basically the model by default assumes that when you input revenues, that your billings are at the same time as your revenues, right? That you're billing for the revenues you recognize during the same period. But you don't have to do it that way. The model has separate lines on the forecast sheet to collect billings in case you bill in advance or in arrears of when your revenues are recognized. And so by default, the models, the input for use automatic revenue recognition is turned on because it's going to automatically look through your revenue to figure out kind of when to do a billing schedule based upon that. However, you can also enter in your own discrete billing schedule directly on the forecast sheet simply by creating a line here which reflects billings and then using the drop down here to input your billing schedule, right? So, but by default, it's going to assume that your revenues, your billings is equal to your revenues, but you can turn it off if you want to create your own kind of custom forecast for that. And accounts receivable works the same way as well. By default, the model is going to say, hey, I'm going to try to create a cash collection schedule based off of your revenues, and it's going to use this input here for days accounts receivable. But if you don't want to use that, you can also enter your own schedule directly on the forecast sheet by entering your own schedule when receivables are collected, and then choosing cash collected from the drop down as well. The accrued liabilities and prepaid expenses, these are simple assumptions, but basically for these kind of three counts on the balance sheet, the model just uses an assumption of what the percentage of SG&A is prepaid or payable liabilities. And all it does is it takes the expenses that you've entered in the forecast sheet and it creates a timing difference in terms of when they actually kind of get paid, so that you're accounting for the cash difference and the cash impact on your statement of cash flows in your balance sheet accordingly. Again, if you have a different schedule to create that, you can create your own kind of custom schedule for that directly on the statement sheet. So depreciation, the model will automatically create a depreciation schedule for any CapEx entered. And the way that gets done is, you would take any line, enter in your planned forecasted capital expenditures, select capital expenditures from there. And then the model then has a set of calculations down here, which it looks into a depreciation set of calculations. So you can input your own manual depreciation schedule as well, but by default, it's going to create one single schedule of depreciating all capital expenditures using the assumption that's directly on there. Again, if you need to create more specific schedules, you can do so. You can create different CapEx schedules for different types of asset purchases simply by creating your own schedule and then linking your depreciation schedule into here and selecting depreciation from the dropdown. So it's very simple to create your own schedules to override the default if need be. So on corporate taxes, there's a separate calc here for corporate income taxes as well as VAT. Value-added taxes more for European or businesses outside the U.S. The default assumption is it creates a corporate income, uses the input here for corporate income tax rate, and calculates taxes. Now it does look to the past and see what was my net operating loss. It does net operating loss carry forwards for a period of time, so it's only going to pay taxes when it feels that the net operating losses are extinguished or the carry forwards are gone. It's going to create an income expense for the profit and loss or income statement in the month that the taxes are incurred, but it's actually going to pay them based upon the schedule here. You can select whether they're paid monthly, quarterly, or annually, and the detailed forecast schedule for that is directly here on the bottom of the forecast sheet, and you can basically see how their corporate taxes are accrued and then basically dispersed and come off the balance sheet. The same structure works for VAT. The one caveat to the VAT side is by default it assumes the VAT for a full percentage of revenues. Oftentimes people need to create their own custom schedule for deductions to VAT, because this is going to do a schedule of like, here's VAT I'm accruing, and then when it actually gets dispersed, and it tries to find the difference in terms of what the takes a fair amount of the expenses off of the part that it's due. But sometimes people do need to create their own custom schedule for VAT deductions so they can calculate it correctly. So it may need, that's why there is a manual input line here to create your own schedule for when that comes through. The last section for the balance sheet is around inventory. Now again, it's only applicable for businesses that have inventories or physical goods. What this does is it doesn't calculate like the units inventory, but like the dollars or the currency inventory. And the way it works is there's a line, or there's a category of costs called product materials cost of goods sold. So any cost that you enter in here, you can select to be a cost of goods sold expense. For example, if you were an e-commerce business and you have cost of goods sold components being the actual kind of product you're selling, maybe shipping costs, fulfillment costs, customer support costs, whatever they are, you can enter in each one of those, like fulfillment, shipping, customer service expenses, you enter as a cost of sales. But you can enter in your actual hard product cost as a product materials cost. And so that gets treated as a separate kind of cost of good items. In your total cost of goods sold in your financial statements or reports, it'll consolidate the two. But what happens is any kind of cost that's allocated to this product materials category gets then used in the inventory calculations. Because basically it's trying to say, hey, your inventory purchases, when you actually pay for inventory, the cash from them, may differ from when they actually get expensed through the income statement or through as a cost of goods sold. And so the inventory calculations at the bottom here uses the inventory value at the beginning of period from your opening balance sheet statements, and then calculates out the purchase of inventory based upon your scheduled cost of goods sold. Now, how does it do that? Well, there's a couple inputs on Get Started to do that. There's a couple of inputs here that are used concurrently. So you can either say there's a number of months lead time from when an expense goes through cost of goods sold to when you actually have to purchase the inventory. You can say there's a safety stock. Maybe you want to keep a certain percentage of COGS always in balance, and so the model automatically make purchases whenever it needs to keep that safety stock. And then perhaps you have a minimum order quantity in terms of dollar or currency terms. So instead of making like, maybe you can't make like really small inventory purchases, but you need to buy in bigger lots. It'll calculate out when inventory purchases are necessary to be made, and it'll buy them in the minimum order quantity lots that you kind of assume directly in here. And then the last two assumptions here for when you actually pay for the inventory. So perhaps when you actually make an inventory purchase, you may or may not pay for it at that point in time. You may have a payment schedule where you pay some up front, pay some later. These inputs allow you to modify that, and they all roll through the statements, the financial statements. And so on the financial statements here, you'll see inventory, and you'll see inventory accounts payable, and they come from those core calculations around inventory directly off of here, off the forecast sheet. If you have your own schedule for inventory purchases, you can also create your own. Input a line up here, create your own forecast of that, and then just select purchase of inventory directly from the line here, and then it'll use that purchase schedule kind of directly in the forecast of the model. So you can get really detailed in creating your own logic if you wish to. Questions about this? Ask anytime.